Well, good morning, folks. Well, good evening where you are. It's, of course, early afternoon down under where I am, and it's a nice, bright, sunny day. Thank you for your attendance today. Tom Williams is with us, and we're going to talk today about not only trading channels, but we're going to show you how to construct them. Most importantly, and then we're going to show you the things you can learn from them, including some errors of some parts of forecasting. So these are pretty extraordinary things, and I hope you're going to enjoy it. Let me say that they will improve your trading vastly. Probably more importantly than that, they are going to give you some clear insights into markets. So let's move along and see what we can find. This is going to be a fairly long webinar. If I don't get through it all, I'll do another one. For those of you that are obsessive about trading, which is the best way to be, you will find that after you've seen this stuff and put it on your own charts for a while, you're probably going to have a host of new questions. But this is, I think it's a big deal. I use it a lot, and I've used it for 20 years or so, ever since I discovered the Danielcode. And it's very specific and very clever. But rather than all that, let me show you. We have a short, PowerPoint to start off with, and then that will just introduce you to the major points of it, and then we're going to go on, and I'm going to demonstrate this for you on Forex charts and on futures charts. We're going to see it on one-day charts, 6-day charts, even 24-day charts, the really, really long-term ones. It does give you a special insight into markets, which you'll appreciate when you see it done. So the main thing is there are some very formal rules about how you use these channels, because what we're actually going to use to create these channels is a standard regression tool. Now, if you want to know what regression is, there's a lot of that material on Wikipedia. You can read endless technical and mathematical definitions, but basically what it's doing is that you'll have the main line, the median, which is running off an extended moving average, and that moving average changes as it starts to count more and more bars as it moves along. And it then calculates the standard deviation, which in layman's language is the average amount that this market is moving away from the median. That's a regression channel. Regression channels on their own, you've probably got the tools on most of your software packages. If not, the one I use, and the best one, is on the Trade Navigator software. And if you don't have that, we'll be happy to arrange a free trial for you of that software. But there are some very fixed rules, and these are two of them. If the Danielcode trade channel is moving up, then that'll come in a minute. What we're saying here is a special type of angle, and it contains time and price. Don't forget, what you're seeing on your charts always is time and price. Time is the horizontal axis along the bottom, price is the vertical axis. And there are other things that are in those charts that you can't see, but the tools or the Danielcode studies that we give you will help you to see more in those charts than you actually can. So let's have a look at that. This is what you're seeing now is a standard regression channel, and I don't think your charts have changed yet. This internet connection must be a bit slow. Just bear with me while we try to make something happen here. Okay. Just bear with me, folks. I can see that you're not seeing the new screen here, and let's see if we can get this thing to move for you. Right, it's moving now. So let me get back to where I was. Okay, so we should be ready to go now. I'm sorry about that. This is one of the wonders of technology, but I'm looking for it to change. Now, it has changed. You can now see this is just a standard chart. This happens to be the Aussie JPY, and this tool will work on all markets in all time frames. This happens to be a daily chart, but you can see this is just a standard regression channel, and that's what you get in your tools package. And it tells you absolutely nothing useful. So that's not what we want. What we want to do is to create an actual Danielcode trading channel. The chart you're seeing now, most of you have seen this many times before. This is the S&P 6-day chart. This is our basic timing chart. You'll see that the Danielcode trading channel defines this move nicely and has been defining it since March 2009. So if somebody told you that since the 2009 lows, this market has continually been in an uptrend and a very well-defined uptrend, you'd be amazed, because all of the comics and comment writers have just sort of had everyone on the verge of death day after day after day. Market's going to crash, market's going to crash. This market's never been going to crash on these analysis, because you can see it stayed in that uptrending Danielcode trading channel, and it's been turning very nicely and precisely at all the Danielcode time cycles. If you haven't learned about the Danielcode time cycles, which is the only way to time markets properly, please go to the Danielcode website, www.thedanielcode.com, and click on the tab called Articles. And under there you'll see 60 or 70 articles that I've published in various publications around the world. And look for the two articles called Masterclass. There's one called Masterclass 1, it's about time, and the other one is Masterclass 2, Trading Gold. And you'll see in there that these markets have different vibrations. This is the S&P we're looking at the moment. The vibration of this is 1.593. The vibration for gold is 44. And all of these vibrations are Danielcode numbers. And if you don't know what I'm talking about, have a look at the Danielcode website. If you would like, we'll be more than happy to give you a free trial so you can see what's inside it. But the articles and the videos, they're available to anyone. You just have to go there and click on the tab. So you can see that this has been working beautifully, and this market has been in a continual uptrend since it started. Okay, let's get this done. Okay, so all markets have a dominant DC vibration, Danielcode vibration, and the channel tool, to be effective, it must be set to the correct vibration. It does not work otherwise. The most common ratio for futures is the second Danielcode ratio, 59.33, and gold has a special ratio. Some of the currencies have different ratios and vibrations. The most common one for currencies is 1.625, which is another Danielcode number, and the euro often uses the heathen vibration, which is 70. You can read all about that in the articles. So here are the basic rules that we have to have. In an uptrending market, the Danielcode channel tool must maintain contact with at least 2 chart points on the upside, and if the channel is pointing down, it must maintain contact with at least 2 chart points on the downside. Those will be lows. If these contact points are lost, the Danielcode channel is invalid, and then there's no use to it. So what happens if you don't have the correct construction of your Danielcode channel tool is you finish up with a regression channel. And a regression channel will just go on indefinitely, fitting itself to any market structure, because that's what it's designed to do. So we're not using the regression channel. We're going to take the regression channel and we're going to convert it into a Danielcode trading channel, and that's what I'm going to show you. We can say here that most of this stuff is science. It's a lot of it's mathematics, a lot of it's straight off Newton's laws. That would be Isaac Newton. But there is a dab of art involved, and you will get better at this as you do it. And the more you do it, the more you're going to enjoy it, the more you're going to see, and the more you're going to learn. So the best way to learn this stuff is to keep watching this video, and I'm going to create valid and invalid Danielcode trading channels on futures and Forex and daily charts and longer term charts. So you'll pick it up from there. The point is, as you've just seen with the S&P, that markets trend far longer than you think. And the Danielcode channel will clarify your understanding of markets and keep you on the right side of the markets. Now, remember, some of this stuff is occasionally going to look absolutely miraculous. Don't jump away thinking, oh, this is the silver tool, I've got it, this is the silver bullet. It is one of the silver bullets, but on its own, it doesn't quite work like that. There are times when it does, and some of the examples I'm going to show you, you're going to say, oh, you know, this is it, it's all over, I've got it. But you won't have it, because this is a tool that only sets up on specific occasions. When it does set up, it's absolutely fantastic. When it doesn't set up, it means you've got a very strange market pattern, or more likely, you don't have enough data. This tool takes quite a lot of data before it will begin to function. This next chart you're going to see is the one where I said it's pretty easy and pretty fantastic. Now, this is actually the S&P index. If you have a choice between using the index or using the futures charts, always use the index. And this is the S&P index since June of this year. And you can see that's got a valid Danielcode trading channel on it. The thicker blue line in the center is the median, and then the first blue line above it is 1 standard deviation, and the second line above it is 2 standard deviations. And you can see how this market has just hugged the median and just kept working away and working away and working away. And we're looking at an angle, so you'll come to see that highs in the chart are not always highs. They can be highs in price, but they're not highs when you look at them on the angle. In this chart they are, and you can see that the trade channel has worked very, very well as an overbought and oversold indicator. So since June, since this last run up, we can see that any market that's got up to the first standard deviation and then reversed, which would simply be a bar taking out a previous low, has given you a nice sell signal. And on the other side, any bar that has got down to the first standard deviation on the downside or below it, when you get a reversal, that is, the trade is elected, it takes out the high of a previous day's bar, then you have a pretty nice buy signal. And you can see that that's just been, you know, simplicity itself going all the way up. You'll see a black line on this chart, excuse me, saying 1476.07. That's the Danielcode 89% retracement, which is always in black. That's the last level of support or resistance on any chart. And you can see that this chart bounced up near that and then pulled away. We'll talk more about what that means in a while. Just waiting for this chart to change. We're a fair way away from you down here. It should have changed now. And we can use these charts also, not just for their regression channels, but also we use these for our time cycles on the 6-day charts. Don't forget, once you've read these articles that I've got highlighted for you here, you'll understand about time. Very few people do. A lot of people claim to. I've never seen anything that worked other than the Danielcode time cycle, so it's worth your while getting involved in that. Just make a note of these things, folks. If you'd like a free trial of the Trade Navigator software, so you can use this tool, Terry at support at thedanielcode.com can arrange that for you. And if you'd like a free trial of the Danielcode website, he can contact you he can arrange that for you as well. So if you'd like to look at this stuff, contact Terry at support@thedanielcode.com, or you can just excuse me, use the Trade Navigator link on the Danielcode website to request a free trial from them. Okay, so that's the PowerPoint part, folks. The practical demonstration, which is more important, follows. I'm required to show you the compliance disclaimers. They're very important and have been more important lately, as we've learnt with MF Global and PFG. All sorts of things can happen in trading. So be aware that there are all sorts of risks, some of which people haven't thought about before or thought about enough, but there are real risks in trading, so only ever trade with risk capital, and make sure you have your stops in place at all times. Okay, so let's get out of this, and I will start to show you the charts now. This is the 6-day chart. This is a chart that you've seen many times before, and this is the basic timing chart. You can see the Danielcode trading channel on it has run perfectly all the way up. So I showed you a previous chart and said, would you believe this market's been in an uptrend since June? Well, if you look at this, you'll see that this bar here in March 2009 was the low. That's actually moved one. That should have been 59. Sometimes these charts just slip out of kilter, but that was a 59 Danielcode cycle at that low, which we called to the day and traded it. And you can see that since then the market has been in a continuous uptrend all the time. When it's broken below this one standard deviation here, it's done what it would normally do, and we can change this channel to make it 2 standard deviations. And I think in a second or two you'll be able to see that. Yes, you can now. So when these markets escape the 1 standard deviation measure, they go to 2 standard deviations. That's the first thing they do. So other than that pullback, which was back in, let's see, October 2011, this market has been contained by the 1 standard deviation measure all the time from its low in March 2009. So not many people would believe that, but you're seeing it, so that's how it works. Let's move on now and show you how to construct this thing, because there is a bit of technique in it. The next chart you're about to see is Aussie JPY. This is a Forex chart, and what I want to show you is over here on the right. You can see up here there's a tool which I'm showing now, and it's 2 lines with a squiggly line in between, and when you put your cursor on it comes up and says regression line channel best fit. So we always start these Danielcode trading channels from a significant important high or low. This is the last low here. It's June 2012. And you can see the, let's just get rid of this problem. You can see the trading channel moving up, and then it skips across. Just bear with me, please, for a minute, folks. Okay. Just trying to do an intraday update. All right, let's have a look at this. We've got this blue channel starting off here, and it looks fairly good at the moment. Now, this is not a Danielcode trading channel. This is just a regression channel. Tom, can you see this line moving across here? And you'll see that it defines this market reasonably well, and then it stops being of any use to us. It just keeps working until it's defined the whole move for us. So there, what you're looking at there is just a standard regression channel, and that's not what we want, and this is why we don't want it. So let's get rid of that, and let me show you how to set up a proper regression channel. So we start off by clicking on our regression channel button, and then we start to draw it. We're just doing this to change it, so this is important. There's an inbuilt problem with this. Is the way the math works. Let's see if we can get to stay over this side. We probably can't because of the settings on it. Okay, once you've got any sort of a regression channel on your chart, right-click in the center that's on the median and select the Edit button. And this is the box that comes up. And this box gives you all the settings that are in this study. And it's no good to us the way it is. So we go down to here where it says standard deviation. That box needs to be ticked, but 1 is telling us nothing. We need to use a Danielcode ratio for this thing to start functioning as a Danielcode trading channel. And this is the Aussie JPY. I use the 1.593. That's a Danielcode ratio. And if you feel it doesn't quite fit, you can go to 1.625, and they will define all markets in all time frames. Down the bottom here, the next level down, it says dynamic stay. That's how it's set up, and it will just keep moving along 1 day or 1 6-day bar every time that you get a new data download. You don't want that, so get rid of that. That will just turn it into a regression channel. And you can then save that as the default. So let's see what we've achieved now. We can now start to draw something that has a semblance of being a Danielcode trading channel. And there we are. That starts off like that. Okay, the next thing you do, you're still on the properties page here. Right-click on the median line and go to Edit, and ask it to make extensions out to the right. That's this button here. And once you've done that, save it as the default. Now, a word of caution. Sometimes when you move this thing, this dynamic stay at end of visible data will self-select. I don't know why it does, but I've seen it do it on many occasions. If your channel is starting to move around, just check the settings for this and make sure that box dynamic stay at end of visible data is not ticked. So we put on our extensions, and we're going to save that as the default, and we now have an effective 1.593 is now the standard deviation. Now, to start these channels off, we always start at a significant high or low. Chris in the UK, this is something you asked for. As we move this along, you'll see if we move it, it will expand, get bigger, and then eventually it will start getting big enough to encompass the whole movement. The point is that right here, where my cursor is now, and that's June the 7th on this chart, 2012, you have your first reaction from the turn. That's the first high out of the turn. And we know it's a high because it's got a lower bar on either side. When you start drawing your regression channels, that is the absolute key point that you've got to keep hold of. This channel has got to stay touching that point, and you'll see as we move it, it will come off. Now we have a space between that bar and the top, the first standard deviation of the trading channel. That trading channel is no longer valid. So what you have to do is back it back until you've just got contact with that bar. And you want it on the top of that first reaction or as close to it as possible. And you will see from that, you've now got your extension channels. You can't move this up because you're going to lose that contact. Once you've lost that contact, it's no longer valid. Yes, we can get contact with two other points further along the chart, but primarily, unless this chart's moved a good way, we want to maintain contact with that first counter trend. And You'll see we've still got 2, we've still got 2, we're still touching 2, and at this point it's moved to the stage that we don't have contact on 2 points. And the 2 points have to be a fair distance away. Excuse me, don't consider that you have contact at 2 bars and maybe 3 and that's valid. All that is a pivot, and if you keep moving this, it's going to turn around and become a regression channel. So for our work, we want to maintain contact initially with the first counter trend bar and one other point. Now remember, sometimes this sets up about 70 or 80% of the time you'll get a valid regression channel. There are some charts that never create a regression channel for that particular move. They may have previously and they may again later, but for the current move that you're in, they may not give you what you want. So we now have this regression channel, and right down here it fails. We get a close below the first standard deviation. Then we get this rally up. It fails to get to the median, which is what it's always trying to do. So the first thing it's going to do is it's going to drop to 2 channels, the second channel down. So we now have, I've now added the second channel. And in fact, it goes through that, and we can see now that this trend change here is significant. And what the market then does is it will try to regain the original trading channel. And you can see here this market rallied up here on July the 22nd, went to the extension of the bottom standard deviation and loved it, and it was trying to get back to the median, but it couldn't. So it has 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 8 days trying to go running up underneath that bottom regression channel. So bottom Danielcode trading channel, I'm sorry. So what was support back here and here has now become resistance. And you will be looking at this saying, hey, but it's made a higher high. It has on the linear plane. Excuse me, but if you're looking at this thing as angles, it hasn't made a higher high, because to have made a higher high, it would need to be way up here somewhere, because these highs have been running up on the upper level of the Danielcode channel, and this hasn't. So we get this break here, we get a retest of the bottom of the standard deviation, and that's pretty normal, and then it starts to run away. But this was the first clue right here. These closes, 1, 2, 3 closes without a rally below the standard deviation gave us the clue there was a trend change, so we were seeing that way before anyone else. Let's do some more work on this chart because it's a pretty interesting fellow. And I'll show you some variations of that. Okay. All right, here's a significant high up in April 2011. We can start our Danielcode trading channel there. It's now a downward sloping channel, so we need contact at 2 points on the low, and this one here, this is our first counter trend down here, so we're anxious to maintain contact with that. So we move this along, we move it along, we can keep moving it along. Bunch a bit more data in here, and we're still valid because we've got this connected here. And we're still valid, and we're still valid, and we're still valid. And this goes all the way down. Watch back here. This is the key point here. Once we lose contact with that point, we have doubts about whether we have a valid trading channel. Now, on this particular chart, you've got another low there and another low here, and they're very well spread apart. So if you wanted to, you could extend this and look at those 2 points and say we've still got contact, now we've lost it. Okay, you'll see that that one move there, you now have a space between this low and the bottom of the trading channel. That means this is no longer valid. And when that happens, you have to back it up so you do have contact with at least that bar. You'll see from here that we can say that this market ran down its trading channel all the way. When it breaks out of it, we would expect the first thing it does, it would go to the second channel. And it does. You've got this final low down here, has just poked through that trading channel, and it gives a big time snapback reversal. As a general rule, once these markets go to the second level of the trading channel and then make a turn, we expect it to reach at least 2 standard deviations to the high. It doesn't work any further than that. Sometimes these markets will drop to 3 or 4 levels of the trading channel. It doesn't mean it's going up to the 3rd or 4th. It's a part of Newton's law, but that any action has an equal and opposite reaction, but it only applies to the second level. So this bar down here, when you got your final turn down here and this market started to work its way up, we expected that it would go to the second channel, and that's the second channel, and it went there exactly. If we back this off a bit, you remember we said there were 2 views about whether we should be sticking to this, our first reaction from the high, or then using this, the second reaction from the high. If you go back and leave it there, it's a little bit tighter, and it does much the same thing. You'll see that all of these lines that you're seeing, the first and second and third channel, etc., and their extensions, are support and resistance. So here's this market making its turn, and we can say that I can put the spotlight on this now. From this low down here, which is in June, it rallies up, it races through the median, but look where it stops for its first reaction. It knows where that first channel is, so it stops there, and you'll see this time and time again. Then it goes up, it rallies, it closes outside the second standard deviation. Markets find that very hard to do, so it corrects, it comes down, it puts in 3 bars to acknowledge the extension. Remember, this is only an imaginary line on a chart, but markets know these numbers, and it reacts there for 3 days, and then it goes down and it makes its low after the low exactly at the old median. In other words, the unseen mathematics that rule markets and the unseen geometry that rules markets are working all the time in ways that, sometimes you just shake your head in disbelief and say, isn't this fantastic? So let's move on with that. And we can take this fellow off now. He's told us everything we wanted to know. And we can move on and we can look at the run-up to March 2012. Here we have our main low here. This is October the 4th, and that's where we're going to start our DC trading channel from. So we go and pick up our regression tool, which we've now converted into a DC trading channel. And you'll see that that's its first setting there. We have contact with our first reaction out of the low and a second point. Now, I'm not terribly thrilled about this at the moment because those 2 points are fairly close together and it's going to get a spin. At this stage, the upper level of the DC trading channel has come away from that first reaction, so this is no longer a valid trading channel. It's simply a regression channel. And as you'll see, as you move it along, it does all sorts of things. It goes from up to sideways. It's just data fitting itself. And it's where the blue line ends, don't forget, that's where it's got up to. It's just fitting itself to the data, which is its primary job as a regression channel. But look what happens as you go further up. Now we've got our contact back with our first reaction out of the low, and we've now got contact with the rest of the chart up here. So now this has become a valid Danielcode trading channel. So once it breaks through here, you can either keep it going, or if you like, you can say it's going to go to the second standard deviation. And plus or minus about 1, there we are, we've got this back touching where it is. These red dotted lines, which are only forecasting lines based on the part of the channel that you've constructed, which ends at the end of the solid blue line, it has already forecast that high. Okay, and that's not so amazing because that's a 4th degree high. So you guys who did the tutorial you should be seeing that nearly all of these turns are 4th and 5th degree turns. We can, if we want to, it doesn't tell us much from a trading point of view, go out to more channels. You can have as many as you like on it, but they're not telling you anything. The operating parts of this channel, of this tool, are the first and second deviation set up as the Danielcode. Now, just in case anyone came in late, let me just go back and show you this edit box. Your standard deviation value must be set at 1.593. Excuse me. You want the extensions running to the right, and most importantly, this box, dynamic stay at end of visible data. You don't want that switched on. If you have that switched on, it will just keep going, as you see, and it'll just keep following the rest of the chart. So it's now acting as a regression channel. So you must have that box turned off. And what I do is I generally update these every midweek, once midweek, and once at the end of the week. So we saw how that one worked there. Let's go back and find something even more dramatic. That big spike down drop there went to channel 4. Let's do exactly the same thing here. This is probably not going to give us a regression channel because it's so quick that there's not enough time for the data to get filled in. And I want to show you that also so that you understand there are some limitations to this. So here's our tool. It's still saying regression line, but we've changed the settings, so it's now a Danielcode trading channel. We come down here and look. At this stage, we only have one point touching, so that's not a valid trading channel, and it's not till pretty well near the end of it that we get two touching, and here's our first reaction. It's huge. Same thing though, this lets you know pretty clearly, if we go to our 2, that we've had a trend change, and that will alert us that this all this drama of this big fast move down is gone, because once this has moved out of its second channel, that moves over. In fact, the close outside the first channel, which is back here on this first big bar up, which is May 27th, that should alert you that there is likely a trend change. Now, two things could have happened at that stage. We could have got a reversal. This is overbought now. Looking at this tool, above the first or second channel is overbought, and below would be oversold. There was a little trade in here to go short, but it didn't last long. One of the other charts I wanted to show you, moving on to a futures chart, and something fairly topical, is I wanted to show you the crude oil chart. And this is a futures chart. And let's see what we've got here. Yeah, this is a futures chart. Yesterday, my Wednesday, your might have been the day before. This would be your Wednesday. So Tuesday night, we had a sell signal for oil as a TO3. Which is one of the sorts of signals we create for our friends and clients at the web page. And you'll see that signal was posted for Tuesday, which is this little day here in the inside bar. The inside bars, you should have your inside bars. They're very important. You should have them showing in red and your outside bars in grey, as I have here. Incidentally, if you have Trade Navigator, or you're going to have a trial of it, ask Terry to authorize, enable the Danielcode studies, and you will see it will turn it out, setting up your charts exactly the way mine are. So this signal was posted to sell oil on Tuesday, which was this day here. It was not elected, but the next day, whoosh, down it went. Now that's a monster trade. That's a slightly better than 4% move, and it's getting up there in the big time. It was worth over $3,000 per one contract. So today, it just turned around and reversed. And why did it do that? Well, one of the reasons, if we go back to our settings, is you can see that this has got very close to being oversold. So we were likely to have a reaction. So that's one of the things that this tells you. And if we go back to our previous run up, and this is the run up in oil, what I want to do is take off the second channel, but it's telling me it only has one. Let's do the same thing here for you. Okay, let's watch this as it builds up. We start this from the low. Now remember, all these R's that you see in diamonds at the bottom of the Trade Navigator, this is where the contract's rolled over. This is the futures contract. And we don't have an index for this, so we have to use the futures contract, and it's rolled over 1, 2, 3 times in here, and it's quite amazing how that gets quite satisfactorily picked up. So here's your Danielcode trading channel moving along. Here's your first reaction, so you need to keep hold of this point. Primarily, the absolute best way you can get it is if you get the upper channel sitting right at the end of that bar. Okay, keep watching that bar, folks. This is the one back here, which is the July the 5th, and watch what happens. It's still touching it, it's still touching it, it's still touching it. Now it's gone. You see that? With one extra bar, it's gone from a valid Danielcode channel to not a valid Danielcode channel. And if it's not valid, it means it's a regression channel, and they tell you nothing. Okay, so you can see here how these standard deviations work as overbought and oversold indicators. At this point, this market is oversold. Sell the low and down it goes. At this stage, this market, sorry, that was overbought. Down here, we're oversold. Any one bar reversal will get us into the trade. Buy the high of that, and it runs all the way up here. Make sure you have a trailing stop, because we have 2 targets in here. We have, first of all, the median, and secondly, we have the first Danielcode trading channel. So use your trailing stop. Up here, you're very overbought. Markets find it really hard to close outside these trading channels, so you sell it. There's a special technique you use for selling inside bars. If you're not sure what that is, have a look at the PowerPoints and the videos at the Danielcode website. There's a lot of material on how to enter after inside bars. Down it goes. Okay, we don't get anything down here. We haven't quite got down to our lower channel yet. Over here we do. We get a close outside the trading channel, and then that's oversold, so we can buy that high and wish we had a lovely run up all the way up to our upper channel, which is fantastic. Nothing happens through here. It's just following the median. At this point here on this bar, it gets overbought again. We're going to get another sell out there. There's your inside bar. You sell the low of the bar, the first bar. Let me rephrase that. You sell the low of the last bar that was not an inside bar. So you don't sell the low of this inside bar. Sometimes tutorial guys know you've got to just grit your teeth and do it when the other bars are too huge. But if you insist on selling highs and lows of inside bars, you will lose money. It is a statistically losing strategy. So our entry, if we're trying to enter after an outside bar, is to buy the high or sell the low, depending which way we want to go, of the last bar before the inside bar that was not itself an inside bar. So we're selling below this bar on August 21st. Down it goes, down it goes. It gets the median channel. You get a rally up, and then look where it gets to. It gets right down to that lower channel again. So markets know these numbers. They know these ratios, and they're using them all the time. And when you get these things properly set up, you get some wonderful insights. Let's move on to another futures market now, and this is the US dollar index. For you tutorial guys, almost every turn on this chart, I know you all seem to think that natural gas is the best market on 4th and 5th degree, but this market, I can assure you, is just endlessly turning at fourth and fifth degrees. So let's have a look at the dollar index and see what we can do with it. Okay, so this is the current part of the chart. We had our low way back here on February the 29th. So we're going to start to move our Tom, I can't see the audience view, so if these charts don't change, would you just give me a ding, please, mate? Okay, so
yeah, you're on, John.
What's that? Thank you.
You're good.
Okay, so we're starting to set up our Danielcode trading channel here. You can see it hasn't set up. It doesn't have 2 points, so it's meaningless. At this point, it does. I would prefer it to be using this bar as the first reaction out of the low, but it's going nowhere near that, so it's using this bar as the first reaction out of the low, which is March the 15th. All that does is it says to me I don't have as much confidence in this as I normally would with a trading channel. But let's move it on and see what happens. And you can see that eventually it loses that pivot point, so it's now no longer a Danielcode trading channel. It just becomes a regression channel. But you can see how this market has just continued to move inside these areas. So for me, that trading channel is far too big to be meaningful. I wanted it to come down and hit this point here. Well, once it gets out to a larger one, it makes the channel itself larger, and that's not of so much use. Let's see what's happened to it on the way down. You're probably completely confused about what this market's doing, and this will add some clarity to you. All this run through here, incidentally, you tutorial guys, was a fifth degree line, which is why you had this rally up here. This high came at a fourth degree, this high came at a fifth degree, and this low's a pretty near perfect fifth degree. Let's run our trading tool down here, and we'll see what happens. Okay, so here we get a simpler construction. We've got this bar down here, which is July the 27th. That's my pivot. I want it to stay on that bar. I know you could use these ones out here, but it's just going to get too big and turn into a regression channel. We check our settings. Yeah, we're still at 1.593. That's good. We've got that right. So we can just pick up on the end once this little hand turns to that cross. It means it's found the point. You get now. Right here, we do not have a valid Danielcode trading channel because we just bear with me, folks. I've got a message here saying that the audio is degrading. I just want to make sure that I've closed any other programs that are here. Okay, Tom, can you hear me all right there?
Yeah, John, hear you fine. It is breaking up occasionally, but it's not too bad.
Okay, I think that's just an internet issue. So going back here, this is our pivot. This is the first reaction out from the high, and that's our key to this thing. We want to hold on to that. And we go down, and now we have 2 points. We have this point and we have these 2 points here. This is not great because they're very close together. The further apart the 2 points are, the stronger the channel will be. So anyway, let's move on down. We're still connected. In fact, look what happens. You get all the way down, right down to here. That's as far as it can go. And you've still got this point connected back up here, which means this is a valid Danielcode trading channel. And that means that what price action is doing at the moment is simply a correction within the DC trading channel. Now, we can put on our second level here, and we can see that this market, when it broke through the first trading channel, it very nearly got to the second trading channel. That's not close enough for me. I want it to actually be there, but if it had got there, the rule would say that as a minimum from the second channel down, it would go to the second channel up. and it looks like it's probably going to do that, but we don't have a high degree of certainty about it. All we have is this thing correcting inside the trading channels. So that's an interesting insight into that. Let's see what else I had for you. Here's another same thing. I'm just trying to show you this by repetition. Here's the Aussie USD. Same thing. Here is your low. So if you want to run a trading channel, that's where you're going to start. So we're going to start down there, and up it goes. Here's our first reaction right here. This is our first reaction out the low. We want it to hold on to that point, and that's about as far as it can go. Once it loses that point, no, I'm wrong, it's going to come back. Okay, now it's lost it. Once it's lost it, it's no longer a valid trading channel, so you just back it off until it regains that contact again. And look what you can see here. This market breaks, rallies to the median. Remember, we stopped this at July the 11th. So all of this up here is just forecasting where you see the red lines. But you can see how nicely the market has worked on this. It breaks below the first channel. It tries to recover the median, which it does. Now, I told you earlier, all of these lines are support and resistance. In this case, the extension of the median channel became resistance, and it failed. Let's run through this before I put on the second level. Down here, I think this is going to be the second channel down here. It tries to rally again, and this time it can't get back to the extended median. This one got to the median and closed almost right on it. Here you have 1, 2, 3, 4, 5, 6, 7 bars trying to get to the median, and they can't do it. And that market is going to fail, which it does. So if we put on our second channel here, we get even more clarity. We see that this first bump from here, we've moved this on, it's actually come off its pivot there. Let's back it off 1 bar. Now it's got a contact with its pivot, and it's got its second point. You can see this market, when it drops through the first channel, it goes to the second channel, it reverses, it tries to recover the median. That's the first thing it does. It fails at the median because the median is resistance, and there wasn't enough momentum to get it up. It runs down to test the second channel again. Look where it closes. It closes almost right on that second channel. You can see it more clearly this way when we convert the chart from bars to just the moving line. Okay, so then back it goes. It's still trying to do the same thing. It's trying to recover the median, and at some point it can't. The reason it can't, excuse me, is that's a very, very hot 4th degree line right there. And markets make their turns at 4th and 5th degree lines, which are in a way similar to what you're looking at there. They are market lines of support and resistance that utilize both time and price. Don't forget, anytime you put an angle on a chart, it is, and these are angles, you are using time and price. So it goes up here and it fails. So we now know that's failed. And we can now start looking for what's happening with it on the downside. So at this stage, this August the 9th bar is the high. We're going to put a trading channel on there. Down it comes, down it comes, down it comes. Okay, pretty narrow, but that's what it gives you. You have a good trading channel here. You've got, there's your first reaction out from the high. 1 bar only gave you that. This bar, look, big bar, it runs from the, see if I can blow this up for you, but it runs from the, high of the trading channel down to the low. It looked like it was going to go forever, but see how the close pulled back? It didn't want to close there. And then it rallies. Why did it rally? It rallied because this market had already tested the bottom of its trading channel. We can now, when we get a break above it, we can now put on our second level of trading channels, and we can make it bigger so you can see it more clearly. Here's this outside bar, went exactly from one standard up to one standard down, and that caused it to rally. Excuse me, that's exactly the same price behavior as I showed you a little earlier in the crude oil chart. From there, it rallied up, it rallied up. Now, you always get these breaks because not many people know about this stuff. This market knew that it was near the second level of the trading channel, and markets find it very, very hard to close outside that. They have to be a really full-blooded move for them to close outside that second channel. So this one stopped before it. This market pushed its way through it because people don't understand markets terribly well, and then it said, oops, I'm not supposed to be here. So it did a really fast reversal. Now, you just look at this in isolation on the chart, you would have no idea why these moves were happening. But if you look at them in conjunction with your trading channels, they're all very understandable. So down it goes to the median, down it goes to the median. Look how it's tracking the median, tries to have a rally here, comes back, closes below the median, does a little reversal, but it's still moving down, moving down, moving down. And it gets down to this bar here, which will have time for a turn. It will also be a fourth or a fifth degree, and that turns the market around, and it starts to rally. You will see here, we finish with this guy. Where did it rally to? It rallied just enough to take out the stops, which are above this high, which shows you how manipulated these markets are. Now, don't get frightened by that comment. All markets are manipulated all of the time. People have the horrors about markets being manipulated. Of course they're manipulated. All markets are manipulated. You just take a look at what I call an orderly market, which will just show you the degree of manipulation that's involved in markets, and we use that. We want markets to be manipulated. That's what we trade. That's how we can forecast what the markets are likely to do. Let's have a look at this little pearl here, which is our S&P again, and this is at various stages now is one of them, one of the most manipulated markets you can ever see. So let's see what happens when we put our trading channel on here. This is one for its first move. It uses that first pivot. Then it breaks away, and for a while we don't have a valid DC trading channel, and now we do. At this stage, we would have preferred to have had this point as the pivot or this point as the pivot, but you can't manipulate these things. They're either on or they're off. At this stage, it does give us two of these trading channels, 2 points of contact. So we have a valid Danielcode trading channel, albeit we would prefer it to be stronger back here, but this is valid. But we've got to be aware that as our 2 points are close together, it's going to be very easy for this chart to pivot off and turn into a regression channel. But let's back it up. We only just need to get it to make that double contact there. Okay, that's not a valid channel because there's no contact at this point. One more bar, and there it is. There's the valid contact. And you'll see right back from here, and the median here has ended on July the 13th. The extension of this has already forecast this high. Okay, and it's already, let's go to 2. Once it falls out of 1, we go to 2. Okay, it has contained this whole move up. It doesn't get down to the second channel. It just runs along the first channel. Now we're still valid. We're moving this up. We're moving it up. It's moving around. And at this point here, as we move on, even though it's come down and this standard deviation at the bottom is starting to track at least the closes of these bars, the second channel is still holding that point. So you've got 2 ways of it telling you that's going to be an important high. So these are the sort of insights you can get out of this thing. It's moving all the way up. It stays on track all the way, and it's still on it today. So this whole market since June has moved within the same Danielcode trading channel. And in that time, I guess there hasn't been a day when we haven't had some learned economists, I call them witch doctors because they don't know anything about trading. They may know what they're doing with their own stuff, but they don't know anything about trading, saying, oh, it's going to crash, the fundamentals are bad. We don't trade fundamentals. We trade markets. We trade futures and spot. We trade them up and down with leverage. And this is a great tool to show you a little bit about what market's going to do. So we've gone for an hour, Tom, so you folks who are still with us, I thank you greatly. And I'm going to see if you've got any questions here that I can deal with because we can't go much longer. I know you have obligations. Okay, let's just start these at the beginning. I see you're all there. Bruce, no sound. Able to record this webinar. Jerry, yes, being recorded, Jerry. Good evening. That would be Ma, M-A-R, not sure who. David, yes, hi. Jonathan. J-O-H-A. I wonder if I can open this up. Oh, yeah, Johanna Schuster. Can't see any charts on the screen. It did take a while to get started, Johannes. They'll certainly be available on the recording for you. Bingo, yes, he got them, good. Peter Batterard, got it, he's now in Auckland. Hello, mate. Bruce Johnston's lost sound, he's back. He's on a train. At what point was the channel constructed? The channel gets constructed from any significant high or low. And the more significant it is, the better it is. Why 29 bars, Akhtar? It won't always be 29 bars, it moves. So if we look at the, it might have just been where it was when I showed you that example. If you look at the box now, you can see that we're up to 86 bars. So that's just the count of how many bars have been created. And as you move the trading channel along, it naturally gets more bars, and it's the bars that are creating the median and then the standard deviation from there. Okay, let's see what else we've got here. There was the 29 bars. Tom, Glow and Rudolph say hello. And particularly
I know where that came from.
I know where it comes from too. He's having a party over there, and he's invited Glow and Rudolph. What a guy! Okay, Euro USD just left the second SD on the upgrade for a high chance of bullish trend change. Correct. Euro USD. Don't know, Pete. I'll have a real quick look at it if I can. Andrew's pitchfork. Look, interesting. Doesn't do anything. It's an interesting construct. I spent lots of years looking at it. It has no real predictive qualities, although when you use an Andrews pitchfork, you're using 3 points. You're using a significant high-low, and you're using the high point of the first rally out and the low point of the first pullback. So to that extent, it's got some similar qualities to these trading channels, but this is a vastly superior way to go because it does have some intermediate levels, and these things do give you some insights into creating trades, which is what's the name of the game. It's very clever what it does, but it's not as good as this. But you know, use it if you like. One of the problems, Pete, you get too many studies and too many indicators. I mean, I could show you guys any number of indicators and studies that I've created over the years. But the reality is they get into conflict with each other, and then you're stuffed. You don't know what to do. And the essence of trading is to have a clear and simple system that you back-tested it to show that it's at the level of profitability that you want, and then just stick to it. If you're looking at indicators every day and trying to make decisions, you're probably never going to pull the trigger on the big trade. So the essence of good, successful trading is having a system and sticking to it. Akhtar's asking me to do gold. Peter is in Auckland. John Paul wants to know 1.593. What about the other vibrations? 1.625 is the comes from the Danielcode rule of 8, which is on the website, John, under Live at the Springs. It's an audio recording. It'll tell you how we find those numbers on the rule of 8. And that is called a number on the square. It's very close to the 59.3, and often just on our Danielcode retracement tool, you will see markets electing the 62.5 instead of the 59.3. What that means is there's no real momentum in the market, and that the market makers are parking the market because they don't know what to do with it, and they use 62.5 because it's close to 61.8, which is a Fibonacci number, and all those guys are trained on Fibonacci, which is why they don't know how to trade, because fibs are just approximates, whereas the Danielcode retracements, as you know, are exact. So on currencies, in particular on these currency pairs, 62.5 is very common. Jesse, hi mate, what's going on with Project X? It's been driving me mad, Jesse. If you see the variation in the volatility on the ES, these sort of successions of inside bars and narrow range bars, it's not switching. It does have a built-in mechanism to read volatility and switch the speed at which it operates, and it hasn't been doing that fast enough. In addition to that, we've had some real problems getting work out of Trade Navigator, who had some matters of their own, PFG and other such issues, which have had them working on other things. So it hasn't progressed. I'm going to have it running on a SIM account in the next couple of days. We've been trying to prioritize and get out what we can, and we've got a new program, SnapR, which will come out to you as Genie Pro in a week or so, or a few weeks maybe. So let's move on. Jesse, I hope you're good, mate. I know you're up there in Canada. So market will likely keep going up into November, Al Tan. Well, the trend is your friend, Al, until it's not. And I know that sounds like doublespeak, but that's exactly what this chart is showing you, that as long as this market is working up within these trend lines, it's going to go up. Let's have a look at our 6-day chart. You can see here, this is a 6-day chart. This is our timing chart. See if I can make it so you don't have to look at all my little squiggles on there. You can see that this black line up here, 1476.07, is the 89% retracement from the 2009 low right up to the 2007 high. And that's the last point of resistance on any chart. It's the Danielcode black line number. And those of you who look at the Danielcode charts at the website will just see markets turning and spinning and spinning. Now, I put this number up here 12 or 18 months ago, 1476.07, and I said that the market, if it continued its trend, would be there round about the 19th of September. If you go through the PDFs, which are under the tab at the Danielcode website called Trading or Recent Trading, you'll see there's a host of PDFs there going for years, and way back in February last year and before that, I gave folks that number and said this market will be at 1476 on the 19th of September. Well, in fact, it was at 1474.51 on the week ending. That's a 6-day week. Don't forget, a Danielcode week is 6 days, 6 trading days. It was there on the 20th of September. Pretty amazing. But that number, 1476, is going to forecast who wins the presidential election in the U.S. If the market can close on a 6-day chart, if the market can close above 1476, it means that the high is going to be taken out. That means right back to the 2007 high will be gone. So if the Fed and the market makers and the brokerages who are being fed all this zero interest money can get this market to close above 1476, the probability greatly is then that this market will be making new all-time highs. Now, on the speed that it's advancing, that doesn't look to me likely, but it's really interesting that the market recognized that number, which I gave out 18 months ago or so, and then recoiled from it. But anyway, keep an eye on that. It's very interesting, and it shows you the precision of the Danielcode that this market 18 months ago knew that number and went there. Okay, let me get rid of this and see the rest of your questions. So Al, it'll keep going up until it falls out of that channel. Glow and Rudolph. Hope you're having a good time there, Smed. Gareth, hello Gareth in Hong Kong. Good mate. Glad you got home safely. Peter Batterard, hi mate. 1.5933 is the best to start with, John. Yes, it is. The 1.625 mainly on currencies. Chris, Katie, are you backfitting data to the channels? No, they are what they are, mate. I backtest all my stuff for 17 years, and you do it yourself. You set up your regression channel properly. You'll see that it's sort of a light switch solution. It's either on or it's off, and there are some charts that don't create these regression channels because the run is not long enough to create enough data. They do take quite a bit of data before they start to form. Okay, so video, what video are you referring to? We'll record this. GoToWebinar has a recording feature. Who asked that question? David, was it? Yeah. Are there different standard deviation values for different markets? David, yes, there are. The most common ones I've told you. Wayne, no sound. I don't know why that is. Tom, can you hear me all right?
Yeah, Johnny, fine.
Okay, this goes a little off topic. Can you suggest a strategy or indicator to judge momentum coming off? I don't have any forecasting tool for that, Akhtar. You can see it as it happens inside the trading channel. So if you've had moves that have been getting to the first standard deviation and subsequently the market doesn't, that's a loss of momentum. But the real thing we want is we want to know future volatility. And there is no tool in the world that will predict that. Not even I have that. So that's why I teach you at the tutorials to just trade what's in front of you. You will get that big volatility often enough to reward you. Chris Cady, how did you get the 1476 SP cash? It's the 89.89% retracement of the 2009 low to the 2007 high, Chris, which is the last level of support or resistance on any chart. It's the last of the Danielcode ratios. If you look at the Danielcode website, and if you want to, you can listen to that audio at the Springs. It's a couple of hours of audio that I recorded a couple of years ago in Colorado Springs. And it will tell you all about those Danielcode ratios, or better still, if you're not a member, get a free trial from Terry, and you can see it in there. It seems you have to wait a while for a trend to develop before you can use it. David, that's exactly right. That's exactly right. You can go intraday if you like. I don't like to trade intraday or take anything out there, but if you want to, you could. What sort of vibration tracker do you use for stocks? Those big stocks you can use 1.625, Phil. Pretty clever. Yeah, here's a good point. They're great. These things are great in hindsight. They don't seem to be useful until the end of the move. That's Joshua. Joshua, that's right. But once the channel is formed, as I've showed you, the dotted red lines, the predictive qualities of it are really quite extraordinary. Gareth wants to see wheat. I think it's just going sideways, mate. Am I looking for the S&P head higher? Well, as long as it's in this channel, it's going higher, Sean. Once it falls out of it, you'd know it. Greg, natural gas, 1.593. Nearly all futures are 1.593. What DC number does Channel... Hey, Tom, this is Mo. What DC number does Callus Channel follow? Anything he wants. Thanks, Mo. And Callus, if you're with us, congratulations, mate. It was fabulous having you at Colorado Springs, and I know you did the suffering, but you brought a lot of joy and amusement to a lot of people. Okay, we've got too many questions going on, guys, and we have to end. It's 18 minutes past. Hey, Frank's up. Tommy, Frank's awake over in Belgium. God, it must be who knows what time. Hello, mate, how are you? One question, Mike Johnson, do I use the semi-log scale on daily charts? No. You only use the semi-log when you're using large amounts of data going back over some years. Chris, yeah, it's the first counter trend out of the high or low that we use. Can you use it on ETFs or shares? Sure you can. All markets work the same on the Danielcode 151. I don't know what that means, Chris. Have a good summer. Thank you, Chris. My God. Yeah, we're coming into summer. You guys are going to be shivering, and we're going to be getting nice and warm. Anyway, thanks for that, guys. We have to wrap it up there. We've been going for an hour and 20 minutes, and I really do thank you, those of you who've stayed with us to the end. Just use a lot of thought with this. Just remember there's a bit of flexibility in this. Sometimes they're going to set up nicely, and you're going to get really excited. Just make sure that it is setting up and meeting those rules, those strict rules, and just learn from it. The more you do it, the more you're going to see, and the more you're going to learn, and you're going to see all sorts of things that work with it. When I'm on holidays, I just put lines on charts, these trading channels and other lines, and the more you do, the more you're going to know. So good luck with that. I hope you've enjoyed it. If there are a lot of questions about it, please send them to me, Jay Needham at thedanielcode.com, or you can send them to Tom if you're tutorial clients, and we'll do another piece of it to answer all your questions. But you'll find that the more work you do on it, the more insights you'll have, and the more questions you'll have. Here's Reinhard Leasing to join us. Thank you, Reinhard. Tom says hi to you as well. Okay, guys, that's it. Thank you for your attendance. Let me know what you want me to cover in the next tutorial, and we're always trying to give you something new and exciting.
John, thanks very much, buddy. Very, very good job. You were very much on your A game and getting your information out there tonight. It's very, very good.
Just to start, Tom, I could have done this for 5 hours. It's amazing. You guys will see as you do it. Make sure you've got it set up the way I've shown you. The more you do, the more you'll see, and the more questions you'll have. It really is true that all markets turn at definable points. They're either 4th degree or 5th degree turns, or they're turns from the Danielcode trading channel, or both. And the real strength of this thing, as you move on and maybe do a tutorial, when you know almost all those points I showed you where we started these trade channels, Tom, were 4th or 5th degree points. So when you have your 4th or 5th degree on top of your trading channels, you got a very, very strong indication where the move is going to top out or bottom out, and then that's when it's pretty exciting. Anyway, thanks for your attendance, guys. Thanks for your kind remarks. I'll look forward to seeing you next time.
Thanks, Bye. John. Take care. Good night.
Thanks, Tommy. Bye-bye, mate.